There is a number that almost never makes it into the headline. It is not the number the government announces at the press conference. It is not the number printed in the brochure handed to international journalists when the deal is signed. It is the number that lives in the contract. The number that determines, after everything is extracted, processed, exported, and sold, how much of the profit actually stays inside the country where the resource was found. That number, in most resource-rich nations across Africa, the Caribbean, and Latin America, is far smaller than you have been led to believe. And this is not an accident. We are told a story about foreign investment that has been rehearsed for decades. It goes like this. A developing nation has natural resources but lacks the capital and the technology to extract them. A foreign company arrives with money, expertise, and equipment. A deal is made. Jobs are created. Infrastructure is built. The economy grows. Everyone wins. That story is told over and over. It is told in economic reports and ministerial speeches and university textbooks. But the version of that story that is rarely told, the version that matters far more than the press release, begins the moment the ink dries on the contract and the real structure of the arrangement becomes visible. Because what foreign investment often means in practice, particularly in nations rich with minerals, oil, bauxite, gold, and rare earth metals, is not partnership. It is a structured transfer of wealth. It is extraction designed to look like development. And the people living above the resource almost always end up with the smallest share of what comes out of the ground beneath their feet. Let us be precise about this, because precision is what this conversation requires. When a mining company enters a country and negotiates a contract, the terms of that contract determine everything. The royalty rate, which is the percentage the host government receives for each unit of resource extracted, is often the first number to be quietly minimized. Royalty rates across many resource-rich African and Caribbean nations have historically sat between 2 and 5% of gross value. That means for every $100 of resource pulled from the ground, the country whose ground it is might receive $5, sometimes less. The company keeps the rest. But royalty rates are only the beginning. Most large-scale mining and extraction contracts also include provisions for what is called a stabilization clause. This clause legally freezes the fiscal environment at the moment the contract is signed. It means that even if the host nation later decides to raise tax rates, revise environmental fees, or renegotiate royalty structures, the foreign company is protected from those changes for the duration of the agreement, which can run for 20, 30, even 50 years. The country cannot change the rules for that company, even if the entire economic landscape shifts. The contract is a wall built around the investor's profit. And then there is the cost recovery structure. In many oil and mining agreements, particularly those modeled on production-sharing frameworks, the foreign company is permitted to deduct its operating costs, its exploration costs, and its initial capital investment before the government receives its share of the profits. This process is called cost recovery, and it can be structured in ways that reduce the government's share dramatically. In some documented cases, companies operating in resource-rich nations have used aggressive cost recovery accounting to delay the moment when the government sees any profit share at all, sometimes for an entire decade of active extraction. The resource is leaving. The money is not fully arriving. Now pause and sit with that for a moment. A country has oil, gold, bauxite, copper, or cobalt beneath its soil. A foreign company comes in, signs a contract, extracts the resource, and uses legal accounting mechanisms built into that very contract to minimize what the country actually receives. This is not a conspiracy theory. This is a documented structural reality that researchers, economists, and investigative journalists have traced across dozens of nations for more than 60 years. It is one of the central mechanisms through which wealth flows out of the global South and into the financial systems of the global North. And this is where the concept of economic sovereignty stops being a philosophical idea and becomes the most practical policy question a nation can ask. Economic sovereignty does not mean closing your borders to investment. It means controlling the terms on which investment enters, ensuring that your people are the primary beneficiaries of what comes out of your land, and having the legal and institutional capacity to enforce that control. It means the contracts are audited. It means the numbers are transparent. It means the royalty rate reflects the actual global value of the resource, not the discounted rate negotiated when a country was under financial pressure and desperate for foreign capital. Ibrahim Traoré, the leader of Burkina Faso, has placed the language of economic sovereignty at the center of his country's political posture. Whatever one's analysis of Burkina Faso's current situation may be, the intellectual argument he has advanced is one that economists and development scholars have been making for decades. The argument is simple. If your nation's gold leaves on a foreign company's plane, if the refining happens abroad, if the profit is booked in a headquarters in another country, and if what returns to your people is a royalty check of 5%, then the mine in your land is not yours in any meaningful economic sense. You are a landlord who has been convinced to charge below-market rent on the most valuable property in the neighborhood. That reframing is not radical. It is accurate. Look at the history of bauxite in Jamaica. For most of the 20th century, Jamaica sat on some of the richest bauxite deposits in the world. Bauxite is the raw ore from which aluminum is made, and aluminum is one of the most commercially important metals on the planet. Jamaica had it in abundance. Foreign companies, largely from the United States and Canada, came in, signed extraction agreements, and began moving bauxite off the island. For years, the royalty rates were so low that economists openly described them as incompatible with the resource's actual value. The bauxite left the island as raw ore, was processed into alumina abroad, then refined into aluminum even further abroad, and the value added at each stage of that process enriched the companies doing the processing, not Jamaica. In the early 1970s, the Jamaican government under Michael Manley attempted to change the structure of this arrangement. A production levy was introduced, royalty frameworks were revised, and Jamaica began pushing for what it called a new international economic order, which was a broader global movement at the time, demanding fairer terms for resource-producing nations. The resistance to that push was not subtle. It came through financial pressure, through the behavior of international markets, through the involvement of multilateral lending institutions, and through shifts in the political climate that ultimately constrained how far the restructuring could go. The full story of what happened to Jamaica's bauxite economy over those decades is an education in itself. The key lesson is this: even when a government identifies the structural problem and tries to correct it, the architecture of the international financial system often pushes back. The contracts are enforced. The stabilization clauses hold. The companies have legal teams and lobbying networks that operate at a level most governments in the global South simply cannot match. And so the resource continues to leave. This pattern is not unique to Jamaica. It appears in different forms, but with a recognizable shape, across the continent of Africa and across the Caribbean and Latin America. Consider the structure of oil contracts across sub-Saharan Africa. In many cases, the production sharing agreements signed with major international oil companies were negotiated at moments when the host governments had limited technical capacity to assess what they were agreeing to. The companies had geologists, lawyers, financial analysts, and economists. The governments had political pressure to attract investment quickly and generate at least some revenue. The asymmetry in that negotiating room is not abstract. It is measurable. And the contracts that came out of those rooms reflected that asymmetry. In some nations, the effective government take, meaning the total economic benefit that the country and its citizens received from the oil extracted from their territory, when measured against what the extracting companies received, has been calculated at below 30%. In a handful of the more problematic cases, the number is even lower when you account for tax exemptions, capital allowances, and the deductions permitted under cost recovery structures. 30% or less of oil that was always theirs. And where does the rest of the money go? It does not disappear. It moves. It flows into the equity of publicly traded companies whose shareholders live mostly in Europe and North America. It moves through subsidiaries registered in low-tax jurisdictions. It funds executive compensation and dividends. It pays for the lobbying that protects the contract structures that keep the royalty rates low. The money is not lost. It is redirected. And the redirection is systematic. This is the hidden ledger that most development narratives refuse to show you. The conventional story talks about investment flows going into developing nations. But what that story omits is the size and the consistency of the flows going in the other direction. Economists and development researchers who have studied what is called illicit financial flows have produced estimates suggesting that for every dollar that enters the developing world as foreign investment or official aid, several dollars leave through profit repatriation, trade mispricing, tax avoidance structures, and extraction revenue that was never subject to fair taxation in the first place. Let that sink in. The direction of the net flow is often outward, not inward. Foreign investment, in this structural analysis, is not primarily a mechanism for transferring wealth to poor nations. It is, in many of its current forms, a mechanism for accessing the resources of those nations, while keeping the majority of the value within the financial systems of the nations that were already wealthy. Now, none of this is an argument that every foreign investor is acting in bad faith. Individual companies operate within the rules that govern them. Some agreements are more equitable than others. Some governments have negotiated better terms. Some contracts have genuine co-investment structures that share risk and reward more fairly. The problem is not located in any single company or any single deal. The problem is located in the system of norms, institutions, and political pressures that shapes how those deals get made in the first place. And that system has a history. The post-colonial period created what looked like political independence for dozens of nations across Africa, the Caribbean, and Asia. Flags changed. Borders were acknowledged. Constitutions were written. But economic independence, the ability to control your own resources, set your own terms for investment, and build your own industrial capacity, was much harder to achieve. The infrastructure of extraction that had been built during the colonial period largely remained intact, now operated by private companies rather than colonial administrations. The personnel changed, the structure did not. And the international financial institutions that emerged in the post-war period, including the International Monetary Fund and the World Bank, often reinforced rather than challenged that structure. When nations facing debt crises turned to these institutions for support, the conditions attached to that support frequently included directives to liberalize investment frameworks, reduce state involvement in resource sectors, and open up to foreign capital on terms that those institutions prescribed. The intellectual framework underlying those prescriptions treated foreign investment as self-evidently beneficial and state control of resources as self-evidently inefficient. That framework was wrong, or at minimum, it was dangerously incomplete. The nations that have achieved the most durable economic development over the past 50 years are not always the ones that most aggressively opened themselves to foreign investment on whatever terms were offered. Some of them built state capacity first. Some of them developed their own technical expertise to assess resource contracts. Some of them took ownership stakes in extraction enterprises rather than simply collecting royalties. Some of them built processing capacity domestically so that raw ore was refined within the country before it was exported, capturing the value added at each stage of the production chain. This is precisely the model of thinking that figures like Ibrahim Traoré have pointed toward in the context of West Africa. When the argument is made that gold mined in Burkina Faso should be refined in Burkina Faso, or that the state should hold a meaningful equity stake in extraction operations rather than only collecting a royalty, those arguments are not novel in the global history of resource economics. They are the same arguments that Norway made when it structured its petroleum sector in a way that created one of the largest sovereign wealth funds in the world. They are the arguments that Botswana made when it negotiated equity stakes in its diamond sector, producing outcomes that, while imperfect, were dramatically more beneficial to its citizens than the average resource contract on the continent. Economic sovereignty, in this sense, is not an ideology. It is a technical and institutional capacity. It is the ability to understand what you have, to assess what it is worth, to negotiate on terms that reflect that value, and to build the infrastructure to process and export the resource in a form that captures more of its value for your people. The absence of that capacity is not natural. It is the result of specific historical processes, specific institutional arrangements, and specific imbalances of technical expertise and political leverage that have been sustained over time and that continue to be sustained today. Which brings us to the harder question. What changes this? The first change is informational. Citizens in resource-rich nations deserve to know the actual terms of the contracts governing their resources. This is not a radical demand. It is a demand for basic transparency. In many countries, resource contracts are classified as commercial secrets, protected from public disclosure. Audits of extraction revenues are conducted by entities with limited independence. The numbers that citizens see are not always the numbers that matter. Changing this requires a political will to open the ledger. And it also requires a public that understands why the ledger matters. The second change is technical. Governments need the institutional capacity to negotiate contracts that are not systematically disadvantageous. This means training economists, lawyers, and geologists who specialize in resource contract analysis. It means having independent advisory bodies that can assess deal terms before they are signed. It means building the kind of bureaucratic expertise that most wealthy nations developed over many decades and that most resource-rich developing nations have been systematically underinvested in. The third change is structural. Nations that want different outcomes need to be willing to push for different contract terms, to revise agreements where legal frameworks permit, and to develop regional solidarity so that competing nations are not played against each other in a race to offer the most favorable conditions to extractors. When Nigeria and Ghana and Zambia and Mozambique are all competing to attract the same mining company by offering lower royalties, everyone loses except the company. Regional frameworks that establish minimum acceptable terms for resource contracts could fundamentally change the power dynamic in those negotiations. None of this is simple. All of it is possible. And what is perhaps most important to understand is that the status quo is not a default. It is a design. The structures that route resource wealth away from the nations where those resources originate did not emerge naturally from the neutral operation of markets. They were built, negotiated, enforced, and maintained over time by specific actors with specific interests, which means they can be rebuilt differently. The conversation about economic sovereignty is not a conversation about turning away the world. It is a conversation about deciding on what terms the world comes in. It is a conversation about who reads the contract before it is signed. It is a conversation about whose grandchildren benefit from the gold that is in the ground right now. When Ibrahim Traoré speaks about Africans taking control of their resources, the resonance of that message is not primarily about one country or one political moment. It resonates because it names something that people across the global south have felt in their bones for generations. The sense that something is being taken. The sense that the numbers do not add up. The sense that the wealth is real and visible and documented, and yet somehow it is always leaving, and the people who remain are left to manage a poverty that makes no geological sense given what lies beneath their feet. That sense is not paranoia. It is pattern recognition. And recognizing the pattern is where every serious conversation about real economic development has to begin. Because a nation that cannot name the structure of its own dispossession cannot change it. And a people who have been told for long enough that the poverty is their own fault will eventually begin to believe a story that was never true. The resources are real. The wealth is real. The contracts are real. The financial flows are real and they are measurable. The only thing that is not inevitable is the outcome.